Hello everybody, and once again welcome to Synonomics, the money machine. I'm going to go forward in that stock market investing basics. And today, last time I talked about the asset allocation and the portfolio construction methodology. Today I'm going to talk a little bit more about that and expand that into the different types of investing methodologies and how you can assign or allocate your portfolio or the asset classes. Well, there are multiple ways to look at that. For an example, there's a value investing where the investors look at the value, they try to capture, identify the companies which are trading at a much better value, and that's value investing, guys. There's another one is the growth investing where the investors actually pay slightly more for the companies who are growing much faster. And another one, the third one, is all about momentum chasing. It's called momentum investing. Yes, you heard that right. Momentum investing. Here the investors actually pick the stocks which have a momentum from the price perspective, and they ride the momentum. Well, I'm going to talk about that today. Momentum investing. And it's one of the very popular way of asset allocation methodology. But before I come to that, let me tell you that if some of you are thinking that you can get an advantage, a competitive advantage on the price or the market information so that you can actually get a much better price point, that's not going to happen. And here I like to introduce to you the efficient market hypothesis. Well, Eugene Fama actually came out with this hypothesis of efficient market, and according to that, all the markets are very efficient, means whatever information is out there is already priced in. In other words, you cannot beat the market, and if you are beating the market, it's pretty much like an outlier by chance. And just to let you know that Eugene Fama was awarded Nobel Prize for Economics in 2013, and he's also considered the father of modern finance. Well, the efficient market hypothesis has its own pros and cons. A lot of people don't believe because people like Warren Buffett and many of the fund managers as well, they have beaten the market over a long period of time. But having said that, guys, I personally think that it's true. Beating the market is very, very difficult, and that's why for a normal retail investor who are new to this world and who are a little bit of risk averse, they should be investing in the index. Well, if you look at the momentum investing, and it's about chasing the value. So if you look at the momentum investing versus the value investing, chasing the value is investment and chasing the momentum is actually speculation. So you are chasing the price rise. See, the price is going from $100 to $120, $130, $150. You just jump into the bandwagon and ride it out. And that's what in momentum investing is all about. The only point to note is that it's a little bit risky as well, because sometimes it can be the hype. And if you're riding this wave, you should be knowing when to get off this ride. And that's where many of the retail investors like me and you are not able to manage it. And I'm going to talk a little bit about that, the methodologies, how to do it. Guys, there have been multiple biases. One is the, say, conformity bias. If you do something, you just try to confirm it from somebody. Commitment bias, consistency bias, all of these are part of this momentum chasing or the momentum investing. I'll not digress my discussion today by these biases. I'll cover separately in a separate video all the different types of biases, especially the ones which are very relevant to the stock market or in the investment world. But remember, when we talk about the momentum investing, right, the whole idea behind that is that it will continue to go up If something is going up, it will continue to go up, pretty much like Newton's first law, guys, till it gets hit by some information, some news, something which will stop this momentum. But again, look at the other side of the coin. What goes up comes down. Newton's third law. For every action, there is equal and opposite reaction. So whatever goes up will come down as well. So this puts us a little bit into a kind of a confusion and dilemma that, hey, what is momentum investing all about? If I am riding the investment momentum and it has to come down, then ultimately I'll get back to the point where I started. Guys, that doesn't happen that way. If somebody is riding the momentum, they'll also monitor the growth, and as soon as they see that there has been some kind of headwinds, they will get down, and that's the beauty. Well, there is also a theory of mean reversion, and that happens, right? So if some stock has gone above the mean over a period of time, it will actually come back to that, and that's called mean reversion. And as Ben Graham and Warren Buffett says, in the short term it's a voting machine. Stocks are the voting machine in the short term, but in the long term it's a weighing machine. So momentum investing is actually a voting methodology. Everybody is buying it, the stock has momentum, so you are on board. But over a period of time, actually the stocks will actually represent the profitability of the company. So the risk factor here is that you should be knowing when to get off this momentum ride. My understanding is that there is a time lag between the momentum and the mean reversion. If I give some kind of a quantity here, the momentum, the growth in the momentum is something like 3 years. So basically it will rise. You can actually keep on going for almost a year or so, and then it will come back to the mean reversion there. So you can ride that, and that is the cycle. That's the momentum cycle. That's very important to understand. Having said that, once the stock starts going down after a long and kind of a momentum run, you should wait for that. You shouldn't be catching the falling knife, and that's what the value investors do. They don't chase the momentum, they wait for the mean reversion. When the stock comes down and they see the value in that stock, that's the time to pick that one up. From the technical perspective, once the stock is moving up, you can ride the momentum, and as soon as you see that there are some indicators which are showing that now the momentum has fizzled out, that's the time to get out of it. Having said that, in a good company, it's not always coming back to square one. No. If the stock has gone up 300%, 250%, it will come down by say another 50-60%. So still you will actually see higher highs and higher lows. That means the stock is pretty much in the uptrend, and that's the beauty of momentum investing. So momentum investing is a little bit of a faster investing, is more like a trading strategy than a real investing strategy, in my personal opinion. Well, there are two types of momentum investing. One is the absolute or the time series momentum, where you actually compare between the same asset classes. For an example, if you are trying to compare two stocks, say I'll just give an example of, just for the example's sake, it's not a recommendation, say Nvidia or Tesla for that matter. You are actually comparing that, and you're riding the momentum. Now you will be actually looking at something like 10-month moving average, and till the stock is above the 10-month moving average, you are riding the momentum. As soon as it drops below that, maybe it's time to sell. That's one of the methodology. The second momentum investing type is relative or the cross section momentum. There you actually compare two different asset classes. For an example, you can actually look at stock, equities, and you can look at gold for that matter. And then you can compare both of them, or you can look at currency for that matter. You can look at, in this example, Nvidia or Tesla, and you can actually look at US dollar versus any currency. So US dollar versus Japanese yen. And you will compare the momentum of both these indicators, both of these instruments, and see how, when you have to come out of it. You will compare the returns, the ROC, and ROC here is not return on capital, no, is the rate of change. So you will actually compare the rate of change of the price for the last 12 months between two different instruments. In my example is the equity and foreign exchange, or if it's the equity or gold. And then you can actually see, and based on that run or the return, you will allocate your assets. It will give you a good understanding that what percentage you like to allocate for equities, what percentage you like to allocate for gold or for other asset class for that matter. So these are the different types of momentum investing, guys. Now, I explained that to you. Let me a little bit talk about that, how you, if you are a new investor, how you would like to do that. And I little bit describe that as well, that within the same asset classes, the two different instruments, you can actually compare the 10-month moving average. Well, if I come back to the real process here, the first step is basically to decide your universe and the top stocks that you want to do. For an example, there are so many stocks. If you look at S&P 500 for an example, there are 500 stocks, guys. If you look at NASDAQ for an example, not NASDAQ composite, but if you go to NASDAQ 100, there are 100 stocks there. You have to funnel them down based on your own preferences, your risk-taking capabilities, and the momentum those stocks are showing right now. And in this particular case, momentum is very important. Once you have filtered all those down to 20, 30, 10 stocks, whatever makes sense for you, say 30 stocks, then you equate them in your portfolio, or 10 stocks, you equate them in your portfolio. And after a certain frequency, you monitor the progress, you monitor the price change, the one that I talked about, ROC, the rate of change of the price. And for that matter, the one that I talked about, say 10-month moving average, or you are looking at even simpler than that, you can actually look at some of those frequency, the 12-month return for that matter, 12-month trailing return, 10-month moving average, whatever suits you, whatever is in your comfort zone, in your zone of competence, use that. And once all the stocks are riding that, they are above that, continue the ride. And once you see that they are falling, that's the time to exit. Alternatively, you can also do that. If you have picked up, say, top 10 stocks based on your criteria, you have funneled it down, and then you look at the price comparison on a monthly or yearly, I would say yearly basis, because monthly is too frequent, in a yearly basis. And if you see that any of your top 10 stocks have fallen below the top 50 price points, that's the time to sell. So you choose any of those methodologies to ride this momentum and be part of the momentum investing. Well, I would like to tell you one more thing, that if you really look at from the investment perspective, in the investment world, everybody is a momentum investor. Somebody is chasing the momentum of the price, somebody is chasing the momentum of earnings. Yes, the value investors and the growth investors are actually chasing the momentum of the earnings the company is having, whereas the price momentum investor is just chasing the price. They're riding the momentum of the price increase. So in nutshell, everybody is actually a momentum investor. It depends on what are they riding on, what momentum they are identifying, and also the frequency or the cycle. Well, so the debate, in my personal opinion, the debate about value investing, growth investing, momentum investing is ongoing and will continue to go on. What we need to mean as a matter of fact, the fact of the matter is that we are all investing for growth in the longer term. In the longer term, we want to multiply our money, or we want to grow our portfolio by picking a few good companies, good stocks in the long run. And all these strategies that I talked about it is all about it. So coming back to the point, my recommendation is that whatever methodology you choose, whether you would like to be a value investor, you like to be a growth investor, or you like to be a momentum investor, remember, let your winners run and cut your losses. The very basic thing. Invest in the companies or the sector or the segment within your circle of competence. Know your companies better. And last but not the least, I like to quote Leonardo da Vinci's quotation that simplicity is the ultimate sophistication, guys, and I believe in that firmly. The simple strategy you have, the better it is. Even if you are into the momentum investing, just go for a very simple methodology, the one that I described you. 10-month moving average, for an example. Or if my top 10 stocks are going below the top 50 stocks, I will sell. They are very simple strategies. You don't need to do much calculation. So, with that, I'll give a rest to this stock market basics series for now, especially for the momentum investing in the asset allocation category. I'll come back again on the value investing. I'll talk about the growth investing as well. Remember, all these informations are for education and entertainment purposes. Educational for the guys who are already into stock market, and entertainment for those guys who are sitting in the side and watching the fun. The stocks that I talked about in this video are all my personal opinion, and those were just for the sake of examples. They are not my recommendation. And please consult your financial advisor before making any investment decision, guys. Remember, Synanomics is out there to create financial awareness so that you can learn how to analyze a company, make informed decisions, and make money. With that, if you like this kind of content, please don't forget to like, share, and subscribe. I'll come back again with another interesting topic for you. Till then, it's a goodbye from your finance coach Pankaj Sinha. Bye-bye and happy investing.